Stop what you are doing. If you have more than $8,000 sitting in a checking or savings account right now, and you are over the age of 60, you are uniquely exposed to a massive shift in the financial system. Right now, today, there are updated rules in place at your bank, your credit union, your brokerage, and even your Venmo account. These rules give financial institutions the legal authority to freeze your money for 72 hours, report you to a federal database, and in certain situations, seize your funds completely without warning. You do not have to do anything wrong for this to happen. Consider Dorothy. She is 74 years old. She worked 31 years as a school librarian in Pennsylvania and deposited her money into the exact same community bank since 1986. 6 weeks after her husband passed away, Dorothy went into her local branch to withdraw $22,000 to pay the funeral home and settle his final medical bills. Instead of receiving her money, a manager she had never met took her into a private office and interrogated her for 45 minutes about her husband's death and her personal phone calls. Her withdrawal was delayed by 72 hours. Her completely ordinary transaction triggered a federal suspicious activity report. That report will now sit in a federal database for the next 5 years, cross-referenced against every financial move she makes. Dorothy committed no crime, but her experience proves a harsh reality. Innocence is no defense against modern compliance software. To understand why this is happening to you, we have to go back to 1970. Congress passed the Bank Secrecy Act to catch drug traffickers and organized crime rings moving heavy sums of illicit cash. They set a federal reporting threshold at $10,000. At that specific moment in time, a gallon of gas cost 36 cents. At that time, the median price of a brand new American home was $23,900. In 1970, a legitimate working-class retiree almost never needed to move $10,000 in a single transaction. It was more than most Americans earned in a full calendar year. At that amount, the government caught exactly who they were trying to catch. This chart compares the actual purchasing power of the $10,000 threshold over time. As you can see, that $10,000 in 1970 dollars would buy you what $81,000 buys you today. The government adjusts tax brackets and Social Security for inflation every year, but they have never touched the Bank Secrecy Act threshold. Because that threshold has been frozen for 55 years, the ordinary financial events of a normal 2026 retirement, a $20,000 used car purchase, a $30,000 kitchen renovation, or a $15,000 medical copay now automatically trigger the exact same federal reporting machinery that was originally designed to hunt down 1970s drug traffickers. Since 2024, 6 new layers of enforcement have been added on top of that frozen threshold. Trap number 1 is the senior withdrawal freeze. Over 37 states have passed elder-safe banking laws. These laws give banks complete legal immunity if they freeze your money by mistake, but hold them liable if they release it to a scammer. The incentive structure dictates that banks will freeze your account first and ask questions later. Trap number 2 is structuring. Under federal law, breaking your deposits or withdrawals into smaller amounts to deliberately avoid the $10,000 report is a felony carrying up to 5 years in prison. Recently upgraded AI detection software now flags legitimate retirees who simply space out deposits of $7,000 or $8,000. Trap number 3 is civil asset forfeiture. If flagged for structuring, the government can seize your money without ever charging you with a crime. The burden of proof is reversed. You have to spend your own legal fees to prove you did nothing wrong. Trap number 4 expands the battlefield. Crypto exchanges, Venmo, Zelle, and Cash App are now piped directly into the federal reporting system. The reporting threshold for these digital apps drops to a mere $600 by 2026. Trap number 5 involves everyday businesses. The IRS raised the penalty for an intentionally incorrect Form 8300 to over $3,600. Car dealers, contractors, and attorneys now have a massive financial incentive to aggressively report your large cash payments straight to the federal government. Trap number 6 is digital payment aggregation. If you collect $600 for a side hustle and another $600 splitting dinners with family, the software combines the two. You receive a 1099-K for $1,200, which triggers an automated IRS notice if you do not explain it perfectly on your tax return. Finally, trap number 7 is AI monitoring. Most major banks have deployed machine learning that specifically targets senior accounts. lowering the threshold for what gets flagged as suspicious, timing, or geographic movement compared to younger customers. Intention does not matter. James smoothly moved $187,000 from a real estate sale because he called his bank beforehand. Patricia legally received a $95,000 life insurance payout but deposited $9,000 a week because she thought it was safer. She was flagged for structuring and audited. Gerald wired $25,000 to each of his grandchildren for college and had his account secretly placed under enhanced 90-day monitoring. The compliance algorithms do not weigh your lifetime of steady, reliable deposits. They only look for deviations from the pattern. To keep your money accessible, you have to actively play by the new rules. Here are the 7 specific protection moves you can take this week to completely bypass these algorithms. Step 1. Pre-notify your bank before any transaction over $7,500. Call your local branch manager directly. Tell them the exact amount, date, and purpose of the transaction, and ask them to add a note to your file. When the compliance software scans your account, the note prevents the automated freeze. Step 2. Never break a large payment into smaller pieces. If you need to move $15,000, move exactly $15,000. An automatic report gets filed, but it is harmless. Breaking it into 2 $7,500 pieces creates a highly dangerous structuring allegation. Step 3. Use wire transfers instead of cash. The federal thresholds were built entirely around physical cash. Wire transfers operate through a different monitoring system, with significantly fewer false positive flags on senior accounts. Step 4. Create a contemporaneous transaction log. For every single transaction over $5,000, write down the date, amount, source, destination, and purpose. A clean, immediate log is your absolute best defense against a future structuring audit or civil forfeiture case. Step 5. Separate your digital payment accounts by their specific purpose. Keep personal family reimbursements strictly in one app, and keep anything that could look like taxable income in another. This 10-minute fix prevents IRS aggregation notices entirely. Step 6. Register a trusted contact at your bank. This is a trusted friend or child the bank can call before locking your account. They cannot access your money. They act purely as a human override to confirm your transactions are legitimate, stopping the freeze before it begins. Step 7. Request a senior safe banking authorization. Ask your bank's private banking group for this specific written agreement. It pre-identifies your normal retirement expenditures and clears them against the bank's LBanksLD review protocol in advance. Implementing these 7 steps fully transitions you. You go from being a high-risk target vulnerable to a 72-hour automated lockdown to a pre-cleared account holder who can move their money without friction. There is one final complication. A bank report itself does not mean you owe money. However, the exact same large transactions that trigger these compliance checks, pension rollovers, inherited accounts, property sales, often trigger hidden tax consequences, like severe Medicare premium surcharges. This chart shows a standard low-level retirement income. When inheriting a traditional IRA, rules mandate the entire account must be completely distributed within 10 years. If you take a large, unplanned lump sum from that account, you instantly spike your income. You will be hit with the automatic bank report for the large transfer, while simultaneously forcing yourself into a 35% or 37% federal tax bracket on money that could have been taxed at 12% if properly paced out. The bank report is unavoidable. The tax rate you pay is entirely up to you. Proactive communication with your branch manager, combined with advanced tax planning, is the only way to maintain absolute control over your wealth in this new banking landscape. Set up your trusted contact and create your transaction log today. If you found this information valuable, subscribe to the channel, because next week I am covering the 3 specific retirement account decisions most Americans get wrong. Finally, if you have a parent, sibling, or friend over the age of 60, send them this video directly. They will not hear this from their bank.